We are going back just over a year for these past picks of David Burrows. We're looking at CI Financial. You're fairly flat here. You're still in it. Are you committed to this story?
So we have a pretty good exposure to asset management as a whole. Over the last 3-4 months, I mentioned we've been rotating toward the U.S. So we've been adding to positions like Morgan Stanley and BlackRock. The Canadian market, we think, is somewhat less attractive. So our position in CI would be about a third of what it was going back a year ago. We bought the stock in the low 20s in 2012 and had a very, very good pass on it, paid us nice dividends along the way. I think it'll continue to. I think, though, that there's a little bit of black cloud hanging over the Canadian market. And so I would steer people more toward U.S. asset managers today, although CI is a great operator and has got good returns.
A lot has been said, and you mentioned off the top about how some of the retailers in the U.S. can benefit from lower energy prices. Here's the Home Depot you recommended a year ago. You're up about 30%, and does this story just keep getting better?
Yeah, this continues to be one of our biggest holdings. We've used it as a top pick a couple of times over the last year. You know, it's a great example of what we look for. So at the time, we were looking at a sector that had been out of favor for a long time, retail in general. We were looking for a company that was good to begin with, but came out of the recession stronger than it went in. And if you look at it, you know, their same-store sales in the most recent quarter are up about 6.5%, about twice the growth rate of the U.S. economy. Their margins have gone from 7% to 12%. They've raised their dividend over the last while from $1.33 to $1.88. And they bought back so many shares that it cost them fewer dollars to pay the dividend at $1.88 than $1.33. They are in the sweet spot, and people may not go out and blow their brains out on luxury items, but they are spending money renovating their homes, and as the consumer has a little more money, you know, there's pent-up demand there. So I think this is a great way to get exposure to the U.S. consumer in a company that is executing all the way around.
You also chose LyondellBasell, and this stock's up 5%, although you are since out of it. You hit a target, or the story changed?
Well, no, we had a very large weight in the chemicals companies. We had Ashland's, we had LYB. Stock hit a high of about $115. We came out of the stock around $100. You know, the chemicals have pulled back through this fall. So in general, chemicals do well with a strong dollar and weak natural gas prices, which has been the case. They certainly did correct through the fall this year. So it's a group that we will continue to look at because we think that natural gas prices are going to stay low. But we use stops and we get stopped out and took the profit.
And you saw some weakness developing as well?
Yep, absolutely. Yeah? Mm-hmm. You know, so with stocks roll over, that doesn't happen all at once. And so we use point and figure charts to help us identify when trend is changing. Stocks pull back naturally within trend. What you want to protect against is when they change direction, and that's where the stops come in.
Just a bit of extra time here, David. Would you say that Canadian investors on the whole are too heavily invested in energy, and there's just too much of a focus in that area? And I'm not just saying that based on the recent downturn.
Here's the thing. People tend to get caught up and emotionally vested in what has worked for them over a period of time. And when themes start to roll over and come to an end, you have to be prepared to move on. The last thing you want to do is look backwards and say, when am I going to get a chance to catch a bounce in these? You know, it reminds me of 2003 when the question was, when the market started getting better, is it time to buy Cisco and Microsoft and Nortel? And of course, it wasn't. Mm-hmm. You know, that trade was over. And for now, I think that the energy trade likely is over. And you want to move on to say, what is it that benefits? Because oil's been cut in half. And there's a lot of great sectors that have much better dynamics that are under-owned. So yes, I think most Canadians have too much exposure still. They forget that these are cyclical, and you have to watch for the signs of a new theme taking over.
Okay, David, a short break here. We'll get back to questions right after this.